Hi, my name is Ernesto and I'm a Forex algo trader with years of live trading experience and positive results using Statistical Edge and EAs. I'm one of the best retail algo traders in the world with a solid tracking record you can verify, and today I want to share my knowledge and connect with more traders so we can grow together. I already uploaded the video for the creation of a free model. In this case will be the investing part, let's say the initial phase of any decent trading and investing model and algorithm. So in that video I was explaining that I use the base of one model and then continue optimizing until I can get the best results possible. In this case I started here, we could say, then next to X9, then Y1 and testing 1. This is currently the best one I'm testing. By numbers you will say this is trash, this is ugly, and yes, it is. You can see this was very low compared to the last one, and this was better than the third one when I moved. Why I moved? Because these two used an initial model that I was using the past 2-3 years. So I managed to optimize both my code and my strategy. So now I have better tools to approach the market with the same data that I already traded live and the data I use past to optimize the B1 strategy, we could say. So this one, we could say it's still very heavy compared to this max drawdown, but I was able to raise the profit closing, but it wasn't very good. As you can see, the difference is huge. Here the balance was very clean, so I had to make some changes. I'm closing way less profit compared to even to this one, to the first one, but my drawdown is very clean. It's very low. Like here I topped at 66% in 2020. That is currently the range I'm testing, and this new model is closing less than 1%. We could say 1%, and the profit is very low. But that's important, that even in those big spikes, in peak, that's 2020, so it's pretty much this zone. No, sorry, it's this candle, or a combination between these two candles. And then we have also this trend. I think that I'm not creating big drawdown there. I need to go back check, because once you move the things in the initial logic of the strategy and the EA, everything changes. So that's what happens when overfitting, you know. So that's why it's very important to not keep only one range testing, you know. So test 1 year, 1 month, and then go 4 years, and then go the full 20 years of data, but keep testing in all the ranges and make sure it works the same, or it's giving at least good results. So let's go back to the Excel, and you can see that, well, in this case I'm working with 2020 because it's the lowest risk reward, we could say. It's a very simple formula. You're just dividing the profit versus the max drawdown, that it's your max risk. That in this case, for example, the 66k represents a 66% drawdown. It's not a close or realized loss, it's just the drawdown. Like in these situations we need to give so the EA doesn't have to predict, or we don't have to predict. We need to give something to the market, you know. So let's go back to the charts. In this case, we check, for example, 2008 to 2011. Even though we have a very sustained bullish trend that we know it's because USA is taking hits due to the debt crisis, triggered also by the 2008 housing market, and all of, we know what happened, you know. It's total mess. So even though we had, this is the monthly chart, so having even visible retracement, it's very huge volume. Like this candle, it's 150 USD, $150 move, and we have a $184 retracement. So you have a very clean and sustained bullish trend, but also with very marked retracements. That's why it's very important to use economic or assets that have weight in the economies, not stocks or crypto. Something that one has historic data, and two, that has weight in the economy, like USD, this trend, and COVID and 2013. A lot of things are already giving proofs that USA will remain strong, at least in our lifetime. And gold is gold, like they will remain here. Gold will remain here even when we are already whatever. So, you know, the idea is to have assets that hold value and also that protect our money. So even though I'm giving money, like, I know that this can happen, but this is one scenario of 20 years, you know? So if I don't adapt my EA to every range, if I adapt my range to here, when this move stops, like I'll be fine from 07, 06, 07 to mid, we could say 2010. But when the crisis starts, even though I think my strategy is optimized for every range, maybe here that it's a sustained move of, I don't know how much, let me measure. This is a very dangerous move. This is a almost $450 move. Like, not every portfolio or every strategy can manage those moves. So for example, you don't optimize for that, you blow, but you optimize, you make money when the price retraces, because this is of course a revaluation of the price. Gold cannot be that high, and USA won't take hits that long, you know, like they will recover at one point. And here we have another situation, like this is years of range. You can adapt your EA to this range and you will make millions of, or at least very high percentage of returns. But again, when another trend happens, you will lose everything. So the idea is to have something that adapts to every range. Like if you have a model that trades here, you will make more money here because you're risking more it's like the theory of the martingale. It's smarter, don't worry, we will get to that, but this is just the base of the theory, we could say. You're risking some money, so you know that first of all, the two trades that the EA triggers is for the EA to know what it's going on, at what price it enter, because EA it's not intelligent. Like, that's a scam if someone is selling you that, if they're scamming you. So it's very important for everyone to understand that you need to give money, like perfect entries and trying to predict the trends. It might work, but first try to understand how market works and try to manage your risk. The important thing here is we will be able to understand margin and how it works and how much we can stress our account before margin calls. Testing 100% of margin doesn't mean you are risking 100%. That means that you know what's your 100% based in a statistical edge or data of economic crisis, you know? So even though you can hold this trend, you can also make money here in the range. It will be very low compared to the one when you're giving more. Like if you risk more, you make more. So here you are not in danger, but also you're making very few money. So it's very good model for long term. Takes out all the probabilities and all the guessing games and every noise. And you have very, very clean trading, something you can control, something you can understand. And for example, not dependent of indicators or some tricky triggers or executions that you cannot control. And here it's pure greed and martingale and semi-martingale, because again, we will see that later. Advanced algorithms don't use just your typical martingale but with two multiplier. Like this is just advanced trading, but I'm explaining the base of the model just in simple terms. So I'm gonna go back to the backtesting tool. I'm gonna try to optimize this model as much as possible. I'm gonna do it in a separate video so you can check it out. Have a great day.